Sales tax used to be simple, but then your business grew, and with it came the chaos of managing sales and use taxes in multiple states for multiple products. Thanks to Avalara's suite of sales and use tax products, you can automatically calculate rates, file returns, and manage exemption certificates. Join the tens of thousands of customers using Avalara's sales and use tax solutions to make their jobs a whole lot easier. Avalara, tax compliance done right.
It's a bit of a cold day here in Alabama, so I just turned up the heat in the studio, but I don't think that's what I'm feeling right now. Oh no, we're continuing to turn up the heat on these presentations, and I'm looking forward to this one with David Deppner. David is the CEO and founder of Cyberware, specializing in advanced PPC advertising for Magento merchants. He brings over 25 years of executive management experience marketing businesses online. He spent nearly a decade growing revenue as head of IT and e-commerce at a mid-sized Magento merchant. He holds degrees in computer science and business management and a master's degree in business administration. Join me in the chat, welcoming David to Meet Magento New York.
Thank you so much, TJ. I appreciate the warm welcome. And good afternoon, everybody. I wanted to go into an interesting deep dive into optimizing for profit in the advertising platforms today. But you know how it goes with a topic this deep. We're going to end up skimming through the surface of quite a few things. We'll drill down in a couple areas for a little bit more detail. But I beg your forgiveness in advance, because I'm going to have to tell a few little white lies and forget a few things entirely and leave them off the table. One other point of note, if you want copies of these slides afterwards, my email will be on the final slide and you can email me. I'd be happy to give them to you. I think TJ already did a fine job of welcoming me, but if you're interested in getting in touch, David Deppner on Twitter, and like I said, contact information will be at the end. At Cyberware, we do this all day long. We work primarily with e-commerce merchants. That's our specialty. We do a lot of stuff with shopping feeds and product data and driving profitable advertising for complex businesses with complex product lines. Today, I want to talk through basically four main areas. We're going to talk around why we get profitability wrong in the advertising systems, and then some things about costs and what costs matter and what costs don't in this context. Going to dive a little bit deeper into some issues around bidding in order to explain why some of the characteristics of ad costs are what they are. And then wrap it up with a couple points about budgets, in particular budgets this past year and the sorts of things that we see going wrong that impact profitability in a major way. So let's start out with why we get profit wrong. For the typical Magento merchant, we have a complex product database of anywhere from hundreds to tens of thousands of products. We have many different prices. We have many different average order values, different customer segments. And across these complex product lines, there are usually a lot of different profit margins. Like gross profit margins differ wildly. This causes a lot of problems for the automated systems that the advertising platforms give us to try to manage the bidding and budgeting and so on in the shopping ads and in other forms of advertising on the ad accounts. Most advertisers end up falling back on setting return on ad spend goals and maybe setting targets based on return on ad spend inside the advertising systems. Return on ad spend is a whole lot better than the tools we had 15 years ago, but it has a lot of problems. And one of the key problems is return on ad spend is a simple ratio with conversion value at the top, ad spend at the bottom, and it has no concept of your business model, has no concept that maybe different products might have different marginal profits, has no concept about any of those sorts of things. So any metrics or goals or automation built around return on ad spend, any of that automation is going to make mistakes when it comes to making profitability-based decisions. So the first thing that I would say you need to be doing, if you're not already, is to think carefully about segmenting your products by profit margin. Most shoppers or most advertisers right now are getting a lot of propaganda around Google's new smart shopping campaigns and how great they are. You can throw all these products in a single campaign, flip the switch, turn on the optimization, give it a budget, and it will just go. But the problem with that is when you throw all these different products with different margins in the same campaign, the AI makes mistakes. What typically happens is that as we increase ad spend on an advertising account, profit goes up to a point. After that point, that profitability starts to fall again because we move past a point of optimal profitability and we move into expanding the costs on the account faster than we're increasing the profitable sales coming in. And if you notice at the top of this graph, I'm putting an arrow on one way saying higher ROAS and the other way saying lower ROAS. The thing is, many advertisers think that achieving a higher ROAS is going to mean higher profitability. But the thing to understand is higher ROAS means you're getting more profitability on a single sale, but it doesn't account for the trade-offs between that single sale that you're gaining or losing and how many other sales you could gain or lose by adjusting your ROAS targets. So I'm always interested in trying to understand for an advertiser, where is the point of maximum profitability and how can we try to drive our configuration and our bidding and our budgeting towards that? So just remember, high ROAS does not mean more total profit. Never has, and it never will. Higher ROAS is not a goal you should be trying to achieve. A lot of advertisers make a fundamental mistake when it comes to costs and trying to figure out how much they can spend or budget towards their sales. And that fundamental profit is factoring business overhead into their calculations. Business overhead doesn't actually matter. The way to think about this is when we're in an ad account making decisions about increasing or decreasing spend, getting another conversion or not, if we get one more sale, did business overhead change? No, didn't at all. If we get one less sale, did it change? Not at all. It's basically a fixed overhead cost. It's a sunk cost. It's something that's not material to a decision about small increases in budgets and bidding that are going to drive incremental sales. The costs that do matter are the variable costs associated with making additional sales and the advertising costs. And we're in a situation where we want to achieve the right push-pull balance between these two to get the most total profit possible. When we talk about the variable costs of sale, the obvious one is cost of goods sold. But the other costs that you might want to think about are any other variable costs, like payment processing. Do you spend 3% of your revenue on credit card processing fees? Do you have free shipping? And is that free shipping on some products but not others? Because that could change your effective gross profit margins on certain bands of products. Variable labor costs could also be a factor if you have warehouse employees that scale up and down. But the main issue here is we don't really care about the cost. What we care about is the gross profit margin that's available with every sale afterwards. Because that's going to be the main thing that factors into our bidding decisions. Let's just take a hypothetical example. We've got $100 average order value, 1% conversion rate. You just think about it, that means 100 clicks is going to get us $100. So one click is going to get us $1. Easy example here. And let's just say that we've got 50% gross profit margins after accounting for those variable costs of the sale. Remember, overhead doesn't matter. It's not part of this equation. So if we were to spend 30 cents on a click, it would maybe kind of look like this. We've got 50 cents of cost up at the top. We've got 30 cents of click down at the bottom. And squeezed between those variable costs and those ad costs, we're going to end up with some profitability here. We're going to have another 20 cents in profit that's going to be driven to the bottom line. That's an example of a 30-cent click in this scenario. And clearly, we want as many of those 30-cent clicks as possible. We spend 30 cents, we get our money back instantly, plus another 20 cents. I'll take that deal all day. But what about if we set a 30-cent bid? Remember that bids in the ad accounts, in these auctions, are going to get you all of the clicks at the level that you're bidding at and anything cheaper. So you're bidding 30 cents, you're telling Google, I'm willing to take a 29-cent click, a 5-cent click, a 14-cent click. I want all of those, but I don't want a 31-cent click. And the way that looks from a profitability perspective here is across all of these clicks, we probably have similar revenue, similar profit margins as a whole, but the ad costs slowly eat away at those margins as we increase our bids. remember, in most of the ad accounts, you're seeing averages reported to you. The average cost per click is whatever, maybe it's 15 cents in this case. Those averages don't matter a lot for figuring out profitability. What we care about is over on that edge. If we bid up to 30 cents, are we still making money at that edge? And can we make more? In this case, we clearly can. If we bid 31 cents, for example, we're still going to make an extra 19 cents in profit off of that. So we want to do that. So the rough rule of thumb here to think about is if you've got a 50-cent gross profit margin per click on average, you want to bid all the way up to that point to take all of that extra profit off the table. Think about the fact that most people are making decisions based on averages like ROAS, or average cost per click. And these additional clicks that you can get by squeezing out the profitability all the way up to that edge, they're not going to be at those same margins, but they're still entirely profitable, and we should go ahead and try to get them. So in that example, if we're bidding up to 50 cents a click, our average cost per click is probably going to be somewhere down around 25 cents. We're buying a whole bunch of clicks for more than that, and a whole bunch of clicks for less than that. I'm using really simple examples, and this is a case where I was saying, I'm telling some little white lies here. The actual curve of this line varies wildly. It's not always a nice upward slope just like this. There's plateaus, there's bumps, right? So the averages aren't ever going to equal exactly half of your gross profit per click, right? Your average cost per CPC, if you go in and look at your account, is not going to be half of your bids, but it's going to be somewhere in that ballpark. And that gives us some useful rules of thumb to think about some things about ROAS, which is always also based on averages. So in this example, when we have basically half of our revenue is gross profit, we're going to tend to be at our most profitable level of ROAS at about a 4-to-1 ratio, where we've got the $1 in sales, the 25 cents in average cost per click. And you can kind of think about the math being really simple. You just take 2 and divide that by your gross profit margin. So in this case, 2 divided by 50%, which is 0.5, there's 4 0.5s in 2. So a 4-to-1 ROAS is going to be the right ballpark to start with when you're thinking about where you should set things to achieve more profitability. So, key takeaway, target your ROAS to about 2 divided by your gross profit margin. Remember, this is a little bit of a white lie. This is just a place to start. You're going to have to tweak it up or down based on what's actually going on as you get real data coming in. So the key thing to remember about budgets, I'm going to hammer here, is to stay flexible. To stay flexible and not get locked into keeping your budgets at precisely the same levels no matter what. Because there's a couple key areas that's really hurting people's profitability. One of those is when you have campaigns that are limited by budgets. So Google tells you this when you log in and look at your campaign view. You see these little arrows over here. Limited by budget means that your ads aren't showing as often as they could. Raising your budget can help. Make sure you don't lose out on potential customers. Google's always going to recommend that you raise your budget if you're hitting your budget, but frequently lowering your spend is also a reasonable strategy. But let's look at what is happening here under the hood. Remember, your ads aren't showing as often as they could. What Google actually does is they basically don't enter you into some of the ad auctions you would otherwise be in. So you're going to lose out on a 5-cent click you could have got, and maybe a 10-cent click, and maybe a 23-cent click. You're going to lose out on all these random clicks across this potential list of clicks that would have been profitable for you to buy. So in this case, we got 7 clicks that we lost out on, right? But just think about this. Some of these clicks were far more profitable than others. And clearly, by hitting the budget and not entering these auctions, we left profit on the table that we would have gotten. If you can't increase your budget, the thing to remember is you need to drop your bids. Because if you drop your bids, what you're going to do is you're going to let go of the more expensive clicks at the top of that graph, and you're going to keep all of the less expensive clicks that are even more profitable. And in this particular case, we've got this trade-off where by letting go of 3 clicks at the top that are the most expensive, we kept 7 clicks that were less expensive. And that's going to mean that by dropping our bids, we increased our profitability, we stayed within the same budget, and we've got more revenue and more traffic from it, probably more customers. So remember that if you're seeing limited by budget campaigns, work towards dropping those bids, either by changing your ROAS levels or by modifying your max cost per click bids. Control your spend with bidding, not with budgets. Remember that. Control your spend with bidding, not with budgets. We think about budgets as being from an accounting or finance perspective, about being a control on how the total amount we want to spend. And that's what leads to a lot of this sort of decision making, of just letting those campaigns hit the budget and cap out there. But just remember, you can always drop those bids and increase your profitability while staying within the same budgets when you're in that scenario. It's crazy how many times I go look at a new ad account I've never seen before, and every single one of their budgets is hitting the limit. The second key thing I want to point out, because right now is budget season for many of your organizations, is the cost of having inflexible budgeting. This is an example of spend out of a Google Ads account with no axes on here in order to protect the guilty. The spend was set in October of 2019 based on a 2020 annual budget that was roughly the 2019 performance plus a little bit extra for growth. Obviously, 2020 didn't turn out quite the way anybody expected. But this organization, like many organizations, had their budgets set and everybody had to stick with them. This is what actually happened on the revenue side for 2020 for this organization. They really quickly went up to about between 4 and 8 times the sales that they would have actually had in May. But they didn't adjust their budgets or their spending much at all. This is a problem. It's a problem with a whole lot of organizations. If you think about it from that the bidding example about wanting to get all of the bids that are possible, what happened with this organization is their average order values went through the roof, their conversion rates went through the roof, the value per click that they were getting, the profit per click that they were getting went through the roof. But by continuing to keep their budgets at the level they were, a lot of the additional sales that they could have gotten on top of these amazing results ended up going to their competitors. And in this particular case, we're talking about millions of dollars in profit being left on the table. And these sales were so profitable that if you spend $1 and you're getting $20 back in profit right away, man, I would take that deal all day long. So I'm always a little bit surprised, but I know some organizations have a hard time dealing with budget flexibility, and everybody has to stick with what they're given for the entire year. We're having those conversations with various people right now. And the thing that we just keep hammering home every time we can is just if there's any flexibility, just to shift money from 1 month forward or backward in time, or to use quarterly budgets instead of monthly budgets, or to revisit things every few weeks and maybe change budgets entirely. If you're spending $1 and you're getting 20 back, is that really an expense? Do we really want to think about this in terms of it just being a budgeted cost? So keep your budgets flexible, folks. I think this is one of the most important things. Anybody who claims they know what's going to happen next year with ad costs, or even over the next few weeks with ad costs, isn't telling you the truth. We don't know. Nobody knows. If we can be flexible and work within the results that are coming in, we can squeeze out a whole lot more additional profits. So stay flexible. So I'm just going to do a quick recap on those key takeaways and then open this up for some questions. Remember to segment your products by profit margin. Don't fall into the trap of throwing all of your products into a single smart shopping campaign. That is okay for some businesses, but only if all of their products have the same margins and they do a little bit of extra math to work out the right level of budget to give it. The high ROAS does not mean more total profit. So make sure that you don't fall into the trap of thinking you want to push your ROAS higher. Think about profit, not ROAS. ROAS is not a measure of profit. If you can go a little bit deeper and have some more nuanced conversations about your company's business model and the advertising and how it all plays together, you can make a lot better decisions and drive more profit to the bottom line. Remember that business overhead doesn't actually matter to any of these short-term advertising decisions. Obviously, overhead matters in the long haul, and we need to not drive our businesses into the ground. But if we're making a decision about spending a little bit more or a little bit less, or tweaking budgets one way or the other to achieve more profit this month or even this quarter, business overhead is not material to that. Business overhead is a sunk cost. It's fixed out there. It's already there. We're spending it one way or the other. Target your ROAS at about 2 divided by your gross profit margin. Remember in our example, if we had 50% gross profit margin, that's 0.5. 2 divided by 0.5 is 4. Everybody sets ROAS goals without really thinking this through. Frequently, it's just people pick a number out of the air. I want a 10-to-1 ROAS, or I want a 5-to-1 ROAS. A little bit more work into understanding the metrics behind this and making a more nuanced set of decisions across different product lines with different margins will really help you move towards more profitability. Continue not with your budgets. Don't fall into the trap of letting your campaign budgets hit their limit. And last but not least, just remember, keep your budgets flexible this coming year. We don't know how everything's going to turn out, and we should all be trying to serve our customers better by putting the money towards helping the right people find the right products and the products that we still have in stock if we're having stock issues like a lot of companies are right now. So with that, I'm going to open this up for questions. Remember, go ahead and my email address is right there on the screen, cy@cyberware.com. If you'd like a copy of these slides, just shoot me a note. And with that, I will see if any questions have come in.
Yeah, notes, man. I mean, I've got to write this stuff down. Some really good tips there for how to get the most out of your ads. And I don't have any questions, so post them. We do have a few minutes here for questions. I've got a couple myself though.
Sure.
You mentioned it's better to lower your bids to ensure you're always within your budget limits. But how far does that go? I mean, if you're in a competitive industry and your ad costs are typically fairly high, I'm assuming it's going to go from, you're hitting your budget limits to you're getting no clicks pretty fast. Like, is it just trial and error? Is that really the only way to kind of figure out where you're, kind of walking that line?
What I like to do is actually set budgets maybe 10% higher than what we actually want to spend, and then allow more flexibility to spend around that level and not have it just capped at an exact number. When you talk about a situation really competitive with really high clicks, and that can sure be the case. Like I gave an example where you cost per clicks go all the way down to 1 cent. And in a lot of contexts, the cost per clicks don't even start until you get to $1.20, right? So that's part of the little white lies I was telling about. Where do you actually set things? What's the right level? It's going to be a little bit more nuanced with different things. When you're dealing with consumer products, those bids are going to go down to 1 cent. You're going to get some 1 cent clicks. When you're dealing with Magento developers, maybe not, right? Math's going to be a little bit different. But I will say that underlying principle remains the same. If you're hitting your budget, like mathematically, that means you can drop your bids a little bit from the level they're at, and you will get more clicks for the same amount of budget by just getting a few of the less expensive clicks that you would have gotten anyway if your budget had been higher.
Makes sense. Robert in the chat here asks, what smart shopping campaign type have you found to be most effective? Target ROAS, target CPA, et cetera.
So in smart shopping campaigns, they automatically use max conversion value bidding. So they're going to try to maximize the conversion value, and you can also set a ROAS target on there so it doesn't go below a certain ROAS target. And I think it makes a lot of sense to segment your products by different groups of profit margins, but you also have to have enough products in each of those groups in order to have enough data for the AI to optimize that campaign well. So there's some trade-offs there and some data you have to get into to figure out maybe exactly how to group them. But then within that, you allocate your budgets based on what your results actually are, and you're going to have to control some of your results with budgets, because with maximized conversion value spending, it's going to spend your budget all the way to the limit. It's going to try to spend it all. But you set that return on ad spend target on the smart shopping campaign as well, and you tier those based on the margins of your different product lines. So if you can set those to an initial set that you think is going to work, and then you watch the results that are actually coming in, and you can tweak those two layers or levels, levers. You can tweak those two levers in order to control things based on the actual data that's coming in. All
right, last question here. Does the product segmentation work by creating separate ad groups?
It's going to depend on your context. So if we're talking about smart shopping campaigns, that's a little bit different structure than, say, search ads with text keyword matching and text ads. So the structures are going to depend. The key thing to remember is you need to segment it based on your, you need to be able to bid things differently on the different groups. So Since your bids are kind of set at a campaign level with something like a smart shopping campaign, you'd need to segment into different campaigns with smart shopping. If you're dealing with, say, search text ads, you could do different bidding on every single keyword. So you don't actually need to split those out as long as you have some more intelligent system of knowing what bids should be set at a keyword level. And in older style shopping campaigns that aren't the smart shopping type, you can split out products into their own individual product groups and set bids at every individual product. So it's really about segmenting based on the kind of advertising you're doing, and there's no one size fits all answer to that. Just you need the ability to adjust bids separately for different groups of products with different margins, one way or the other.
I definitely learned a few things about PPC on this presentation. We're going to have about a 30-minute coffee/networking, or perhaps, if you're like me, maybe even a bourbon break before the next session. Word on the street is that Mage Mojo is unveiling a game-changing way to host Magento. You might want to head over to their booth and learn more about how you can take your Magento site to the highest elevation. And I'll see you back over here in about half an hour.